Conference. The idea was a part of the team in 2014, right?
Yes.
Okay.
I think I'm gonna need my mouse.
Maybe, okay.
Well, to like click go down, I think.
Right.
Right?
And she was part of the team. The team won, and we get to go to Denver, to the whole team to Denver and compete with the national level. And we did not win. Gia Wu, my class of FR 3301, investments analysis. She's been out more than 10 years. She's a financial analyst now. She's had several jobs, and I have to tell you the secret about Gia. She calls me every time she changes jobs.
It's a lot. Or it seems like it's a lot.
Okay. Can you please go ahead and come?
Okay.
Please feel free to ask her any questions you have. Feel the open for that.
Yeah.
Discussion.
So, like Mudasab said, I participated in the IRC challenge, and that led me to 2 jobs that I could entertain in valuation. Stout is one of them, and then Global Advisors. Stout got bought out recently, and Global Advisors, all the people I worked with, they're all operating their own valuation firms. How many people of you have heard of valuation?
We will be doing that later on this week. As in company valuation. But here, one thing that I must differentiate valuation of publicly traded companies versus valuation of privately held businesses, correct?
You could do valuations on any kind of.
Of course, but what do you mostly work on?
They could be public or private.
Okay. Oh,
And of different sizes,
okay.
the hundreds of thousands to multi-million. So today I'm going to talk about my role. This is like a little index. What is telecom? How many of you heard of telecom? Raise your hand if you have. Couple people. Okay. I'm going to talk about sources and uses of revenue, expenses, cash essentially in a business. In valuations, there's 3 different approaches to valuing a company for a business interest. You have the income approach, DCF analysis. How many of you have done a DCF model? None of you?
That's later on.
Not
Of
yet.
course, we'll see, yeah, that we would be good that chapter.
Okay. Then market approach, there's 2 different kinds. Look for publicly traded companies using software like CapIQ. How many of you have CapIQ? Bloomberg.
Yeah,
I'm
Bloomberg,
using Bloomberg.
exactly.
There's some things that you're using that you can pull from Bloomberg. I haven't used it that much, but cost of capital, like Moody's 20-year rates, risk-free rates, those are used in valuations. Asset approach, if a company is heavily fixed asset based, that's the best approach to use. Like imagine, it could be a financial services company, or it could be telecom, because they have all this equipment in the infrastructure to make the internet happen. And I'll have examples in my contact again. So these are the companies I've worked with the exception of CFA Institute. I'm working on the CFA level 2. How many of you know what CFA is? CFA. He has a CFA. So you could be a wealth manager one day. But in CFA, there's valuation as a portion of the book. The firms on the left over there, Global View, Senior West, Adams, accounting type valuation firms, all they do is just value companies for financial reporting. So when a company buys out another company, A buys out company B for $10 million. What of that $10 million goes towards technology, non-compete, trade name, goodwill, management agreements, accreditation? So that's for financial reporting purposes, which is regulated. They just want to make sure people are not overvaluing or undervaluing for a number of reasons. You want to pay a fair value amount for it. And then there's shareholder disputes. If you own a business but you don't own 100%, maybe you own 49% of the business, can you sell it for the same price you would if you were not a majority holder? So we calculate discounts for lack of control, lack of marketability, and that's for also gets to the state tax purposes. There's a step up in tax basis when you buy a business, and intangible assets are usually depreciated over 15 years. So So for a lot of what I do for a living is based off accounting regulation.
What's an example of intangible asset?
An intangible asset, can any of you name an example of one? I just named a couple earlier. Trade name, Apple, Walmart, you know their names. There's a value tag to that business name. If you sold it and named it completely different, would it have the same value? Probably not. Yeah, so Marshall Stevens is also where I did a fairness opinion, which is a little bit more complex than a normal valuation. There's a bit of liability. There's stakeholders who want to know if it's worthy to issue out a dividend at that point in time. So in the legal team, I did a stint there a year as a corporate FP&A senior financial analyst. But throughout my life, I've done nearly a decade of valuations, from consultant to a senior valuation analyst to, go ahead.
I was gonna kind of follow up on the legal Zoom. This is a company that basically prepares legal documents, in essence. Yet, she work on valuation. Right? I was just to kind of highlight that, you'd not think that a company that prepares legal documents would hire financial analysts to work on valuation.
Right, so my skill set, valuations, is like case studies. When you take a capstone class here at Cal Poly, you're gonna have to use your corporate finance class, investment analysis. What I do for a living involves looking at the industry, who are their competitors in the market approach. There's transactions and publicly traded companies you use to measure where your subject is. And based off that understanding, you recommend your client. My clients are usually the CFO of companies or shareholders or business owners. And they literally need a report to justify this value. Or if they bought a company, they want to know how much of this $10 million was allocated towards the 10 block. And shareholder disputes, there's valuation committees and worst cases too. How much is this worth? I don't know. Let me get an appraiser. That's an example. I work for a commercial real estate developer as well, so I have experience modeling commercial real estate property, whether or not it's feasible, and you're using the DCF to do that. Discounted cash flow analysis for discounting future income to the present to indicate whether it generates an adequate return on investment for your money. I'm currently at JSI. And if you want to read it, we've been around since 1962. They're a telecom consulting company. We bought two companies, actually. We acquired two companies this year. One was like a tax-based accounting firm, and the other one is like more infrastructure related to expanding operations and engineering type stuff. And my role, I actually had the valuations department technically because my boss left. He was a director needing to be a CFO, the telecom company. So career progression, if you want to do valuations, there's no limit. You could be core FP&A, you could be a CFO one day.
You have to be a CPA to be CFO.
No, you don't have to be a CPA to be a CFO. I've actually interviewed with a private equity firm in Utah 5 years ago to become an interim CFO, actually.
Oh, wow.
And they basically, the guy who was the CFO, I think, which is finance. So. What is telecom? So you're using your computer, but you have access to the internet. So infrastructure, there's switches, there's underground cable and fiber that we've all heard about. Verizon has been a major player building out fiber. So, and there's development and deployment of those things. And it takes, like, there's so much equipment. There's so many engineers, so many offices that kind of make this happen. I could talk about this purchase. This telecommunications, telecom for short, is highly regulated. Fifth Circuit ruling that's going to be happening this March 26th. There's a concern that USF did not allocate their funds appropriately. So there's just this controversy that will be resolved. But essentially, with broadband internet, it takes millions of dollars to put in the infrastructure. And companies wouldn't be able to do it without the help of the government and grant funding and loans. And USF is about $8 billion. That's how much they've distributed in capital investments for this. And the purpose is to make sure that there's people out here who live in rural communities who don't have access to internet. And so our job is to help our clients get grants and loans, build out 10-year projection models, which is the P&L balance sheet, statement of cash flows, building these things out to get the funding that they need every year. As a whole, the industry is ginormous, $930 billion in 2023 revenue, and it will be expected to grow to 1.2 trillion. So that's just wireless telecommunication. The people who sell you devices, that's the wireless resellers. And they also, when you make a call and it's long distance, there's a middle person that's selling that service to another carrier. So there's all these middlemen and technology and equipment to make all this happen. And the only thing that sets it apart if you're looking at competition is pricing, network performance, customer service, and diversity of offerings. A lot of people are cutting the cord. Not a lot of people have landline telephone service anymore. So from 2G to 5G to 6G maybe, like it takes a lot of capital investments to make that happen. And the number of people using smartphones, you can see is exponentially growing. This is from 2011, the industry grew 253%. And for 4G type technology, it's now at 248 billion. This is the trend going into 2019. It's probably closer to 900 billion by now. And our expectations are basically, well, we basically beat expectations. That's the purple line. As you can see. A lot of what I do, you have to understand what's happening in the industry. And there's a lot of terminology you have to understand. So hopefully by going through this, it makes more sense. Yeah, so GDP is 15 trillion and will go to 21 trillion. Basically 10% of the US economy was due to the growth of the wireless industry. And what I'm trying to say is there's a huge, like, if you have a minor in economics, so like GDP, 70% of it is made of consumer consumption. And if you think about this number, it's just quite huge. 10%, literally not just 1%. So in this chart, it kind of segments out what our economic growth can be contributed from. And you can see just the 253% just by wireless alone. Like when you think about looking at a stock report or earnings call, you hear, oh, earnings grew by 10%. Well, it really depends on where you start. Point A, right? Point B. And so even though the industry grew, it doubled in the last couple of years, the doubling based off $1 billion plot, just in relative terms.
What was the reason for that? What was going on in the industry that went through so much growth?
Wireless communication, fiber, essentially. Yeah, so this is, I think I'm going backwards, sorry. All right. A lot, like I said, a lot of infrastructure requires capital intensive money. And so fees for names, ACAM, Connect, CAF, RDOF, and enhanced ACAM support are literally revenue streams for companies that operate in telecom.
And these are programs from the government?
The government.
Oh, okay.
These are grants that
And who benefits from these programs?
operators who are trying to put out lines or infrastructure.
So it's almost like tax, it's almost tax incentives or incentives for companies to invest.
I guess so. I mean, it's free money unless it's a loan,
Okay.
but they also require you to provide 100 upload, 20 download speeds, which is really not that much.
Okay.
And you have to use the money they give you within 10 years. If you don't, right,
We should question now, how is Trump affecting this, if at all?
yeah, I mean, with the Dodge in place, every committee and agency, they're going through budget reviews and whether or not it aligns with the president's goals. So it's to be.
So that's at risk now? Those programs are at or potentially at risk?
These ones are not,
Oh, no, okay,
but the ACAM actually only goes into 2028.
okay, so it's but maybe you could still cut it off.
Yeah, we could. Timing.
You
Okay. So here, historically wired landline telephone service. They offer, I liked the money, incumbent local exchange carrier. So like, and the industry as a whole, like, was a monopoly. And then it got broken out into several telephone
What was it
companies.
off?
I can't say exactly, but and then the small operators took a bit of the business. But now there's so many people who are involved. And now they're receiving payments for broadband. So what's not regulated is voice and internet. So that's the money that they're providing to people who want to expand their broadband, the internet. Like I said, it's heavily regulated. This industry requires a lot of upkeep and maintenance. So when you're doing projections of this kind of cash flow analysis, you have to consider maintenance, capital expenditure, and growth to expand the fiber, right, to different communities and the reach. Valuation, drivers, and telecom made up of tangible assets. So think of any hold infrastructure, towers, fiber optic networks, and handhold spectrum licenses. So what's interesting about that is the government actually holds onto it and allocates it to people. And if you don't use the license, I think it's 10 years also, then they take it back. So if you don't use the spectrum license that you were given or you bought, then you have to give it to somebody else to do. And generally what that's saying is it's not feasible to build it out over there when it's too expensive or cost prohibitive, right? Like there's not enough demand for it. Customer contracts by value. I already kind of touched on the value, but I'll go into detail later. But usually we're comparing publicly traded companies for when we're looking at comps. Income approach. How predictable are the cash flows? Your revenue drivers driven upon demand. How competitive are your prices? Could they go elsewhere? Cost approach. Yeah. Replacement cost for infrastructure. We use the producer price index to figure out what a piece of equipment is worth today. So sources and uses. ACAM is a form of internet deployment. You can read it. It's just here. What this is doing is helping rural communities get internet access. And I worked on a model where they had ACAM money up until 2026. What happens if they, like after 2026, because you're spending $1 million every year on capital expenditures, they can be 10 million more. So in our projections, we have to consider, well, it will renew for another 2 years. Otherwise, people would go bankrupt and we would be able to offer you service. So a lot of things in valuations depends on good assumptions. In every company, you have to understand the drivers of revenue, the P&L statement. So these are examples of what you would find. Voice services, network access, USF HCL is actually one of those grant funding revenue items. And high cost, low, basically is for the rural community, reference to that. Full long distance revenue, broadband revenue, video revenue, other non-regs, so voice and internet, like I said. EMS, CPE, customer premise equipment, rental revenue. You have your cost of goods sold, plant operations expense, and other OpEx expense. Do you guys have any questions here? On P&L, what it looks like?
P&L schedule or table. What's the most difficult part to forecast?
So we have, every industry has KPI metrics, like KPIs, key performance indicator metrics. And average revenue per unit is viewed upon. We look at subscriber data to drive revenues, like how many voice customers, internet customers in residential and commercial.
And you use that to at least start the forecast of sales.
Correct. So we toggle based off revenue per customer depending on the segment of business. This is an example of AT&T and their breakdown of their plans. As you can tell, there's a trend towards moving to unlimited plans. I'm sure all of you have unlimited if you can afford it, which is kind of essential these days. I just have more examples. T-Mobile,
I just switched to the
Verizon. Examples. So this is an example of an actual company I worked on. They received 100% grant, which is nice, because usually it's 50% grant, 50% loan. And basically it allows them to provide to over 2,000 people, 47 businesses, 42 farms, and 2 schools probably in the county of Texas. With that kind of, with the $4.7 million. And another example, this one I actually worked on as well, is a JVN 100% loan. But this one only serves 329 people, 7 businesses, and 178 farms. Like, these are rural communities that wouldn't be able to afford to have internet if they couldn't get this loan or grant, right? So one more example, Western New Mexico, 44, almost 45 million dollars that got deployed to provide high-speed internet to over 600 people, 25 businesses, 6 farms, and 1 school.
That's a lot.
Yeah. So, like I said, this industry requires a lot of capital, and you need to understand, will we get this capital this year, next year? And they do this every year. It's called Reconnect. They're on Reconnect 5 now.
And without the government funding, you cannot do that. There's no way to
Oh,
get
there's no
money.
way. How are we gonna raise $45 million in a rural place?
And how much business are those 656 people who generate to justify the investment?
Great question.
Yeah, there's no way.
Yeah, so JSI, I say they do studies, feasibility studies, and mapping, like just to make sure, like what's the reach of the project that it'll take them. And it just has to make sense, but maybe sometimes it doesn't. But what do you do if you want internet, right? Still, it's worth trying. And if you're the operator building on internet, then you're gonna make a ton of money in the long run. But you're also gonna spend a lot of money in the upfront to make that happen. It's a long game. Any questions?
Yes, question. So it's a loan for 45 million, and for that little people, how are they ever gonna raise enough money for them to repay that loan?
That's a great question. Maybe they're targeting to build in that area, but I don't know the entire detail on that.
So the money coming from the federal government, correct?
Yes,
And it's then being loaned out to the company.
yes.
Is there any other? Yeah, this is not federal for sure. So There must be some kind of subsidy or incentive from the government to this company.
Yeah.
There has to be, otherwise, you know, I mean, how could you make money off of 1,000 people, you know, when you invest $45 million?
Well, that's the current, you don't know how much it's expanded since,
Yeah,
but yeah, hypothetically, yeah, just looking at it, it's like, how is that even feasible? If you guys want to do more research.
Yeah.
do it. But I basically did a Google impairment analysis on this company. 1 of 5, actually. And what is that? Google impairment is, Google is an intangible asset that needs to be valued every year. Tested for impairment. If your book value is lower, sorry, if your book value is higher than your future value, fair value of assets, sorry, then you're impaired. Basically, you want to be generating more than your book value of assets. The OpEx side, the B program has about $42 billion to help lower costs and obtain access to high-speed internet. And I kind of talked about that already, like they're trying to get 100 megabits down to even 20 megs upload speeds for locations that have no access currently. The only costs to the people who are applying for these grants are the compliance costs to get the model built.
valuation model that is.
Valuations, projection model, and audits for cost segregation studies. If you guys don't know what that is, do you even know what that is? Cost segregation studies. So in accounting, when you buy fixed asset, renovate a building, old building, do improvements to it, you can write down depreciation costs. So it bumps up, it lowers the amount you would pay taxes, essentially,
Versus your cost.
versus your cost. This is just showing the trend of where 2G to now where we are, 4G. The amount of capital spent to just get it working. And the most recent period to 2019 is a 42% increase. Okay. What is it used for? It's to upkeep the current fixed and mobile network, maintain copper infrastructure for people who still have copper, roll out new networks, maintain the high network, and just to maintain it, IT costs.
You can invest a lot more than we do. So what is it? European average versus North American average.
Yeah, I'm not sure why. Maybe they're.
It's
I'm not sure.
quite a bit, well, we're catching up with them though.
But again, the regulatory nature. FCC is the one in charge of managing everything. And the companies that are affected are ILEX and RLEX or even CLEX, incumbent local exchange or competitive local exchange. And then USF and USAC are support payments. So anyone can go on the USAC website and look at how much each company is receiving every year through period. And it depends, and actually varies year over year. And I'm not exactly sure why, but maybe it's like you have to make certain, like there's requirements filled out, profitability, upload speeds, like the earlier 100 up, 20 down. Like basically companies meet that, and if they don't, maybe they adjust the funding levels. I've only been on the job for a year, so I don't know all the details yet about that. So the income approach of the discounted cash flow method. If you're the analyst and you're working on the valuation for this company and they have regulated and unregulated revenue, they normally separate it. And as an analyst, you want it to be compliant. So that's part of the heavy lifting. It's just like organizing the, And usually you want to forecast 10 years out. Unlike most businesses, telecom companies operate on a negative working capital. How many of you know what that means?
Sure.
What is working capital? Take a wild guess.
That's the
Anybody?
company.
Anybody? Okay, so it's money you need to make the day-to-day happen. Do you have current assets minus current liabilities?
That's network.
That is not.
Right.
And sometimes they exclude cash and defer revenue. But, for example, this is like what you would see in year 1 to 3. Not a really good example because we're working in millions, but it's reported here in thousands. But you have revenues, EBITDA, CapEx, change in deferred revenue, change in working capital, and you want to consider if the deferred revenue is actually going to be collected, or if it's collected, make sure that the work is being done. In a DCF, free cash flow is like standard. That equation you should be familiar with. If you want to know how much cash is left over for shareholders, that's the equation you use.
Yeah, that's chapter 13. We've not done that.
Oh,
We're
okay.
doing it wrong. Free cash flow to defer. We talk about FR 3000 to some extent. You chapter 10, capital budgeting.
Go ahead.
What's the D and A after having?
Depreciation and amortization.
Okay.
Non-cash charges.
And what you're talking about in that equation is depreciation is not an expense, even though you think it might be. Like it's not a cash expense. It's something that for tax purposes looks better on paper. It makes it look like you're making less money, but you're not. It's like if you own an MacBook Pro and it only lasts 5 years, technically by year 5, it's worth nothing because it's fully depreciated as an asset. But to you, you know you spent $2,000 on it. But by year 5, it's supposed to be worth less because its functional obsolescence has taken effect. And so, more cash is collected up front when you have deferred revenue. And if deferred revenue decreases, the company is recognizing more revenue than payments or reduces free cash flow. Does that make sense to you guys?
If I may just say, that's free cash from the firm. One way to think about that, that's the unencumbered cash flows. Cash flows that are available to the suppliers of capital of the firm after all expenses and expenditures have been accounted for.
So like if you're a business, how do you make money? You have people who work for you, you pay those people, you have roof over your head, you pay the plant costs, all these costs make it happen. You wanna take out you're gonna take out depreciation to get to EBIT, that's how you're adding it back. And you wanna deduct taxes because the government wants a cut of every dollar you make. And then CapEx, you have to, if you wanna continue to operate into the future, you have to continually invest in the business, whether it's buying property, plant or equipment. You have to have that, so you deduct it from your earnings, the future expense, but it'll be realized today for the future. And then change in net working capital, what you're spending on today to make your day-to-day happen. So that's what that formula is all about, and you need to know that.
You will see that in chapter 13.
So modified CAPM, who has heard about that? Forward growth model, anybody?
Yeah, what we go to, that's the basic valuation model that you have done about FR 3000. Partial risk mark is equal to next year's dividend divided by the return, ownership growth rate. No, that's the growth rate. I don't remember that.
So, because of the high capital investments, lending, cost of debt is really high for these types of firms, or just the amount of borrowed money. It's usually anywhere from 50 to 80% of market value invested capital. You guys know what that is? It's debt and equity combined. So, and usually that's adjusted for location, size, the diversity of offerings and other characteristics. And WACC, weighted average cost of capital, is the discount rate which you discount your future cash flows by. And it's super important because the one number you can modify by adding like a industry risk premium or a company specific risk premium. But the hard part is, especially I think going into this field, there's so many companies out there. How do you know which ones are actually comparable to your company? And you have to go through the business description to really understand the industry. There's like integrated carriers, AT&T, Verizon, versus pure play, T-Mobile. Mainly when you think about T-Mobile, you only think of like mobile, voice, internet. But back in the day, AT&T and Verizon, they offered other things, not just, you know, voice and internet for the phone like T-Mobile has. I don't think T-Mobile has ever offered voice like landline, stuff like that. So that I'm trying to distinguish that there's various companies that can do different things, and when you're valuing company, you have to know what you do and make sure you pick a comp that's just like them. In this world, there's no one like you, for instance, so it's hard to say it's comparable to an exact match. Fixed line versus mobile, fiber optic providers, mobile only.
A little trivia about T-Mobile. I think it was started by Deutsche Telekom.
Yeah, it's telecom.
This is kind of a snippet of a DCF, very basic. We hit all the, revenue line items and just called it revenue, because I don't want to list all of them. And then you have EBITDA, so you've already taken out your OpEx, cost of goods sold. Depreciation expense, what are we doing there? Probably taking it out because you want to get to EBIT. Income on tax on the earnings to get to net income. No debt, because remember, we're trying to figure out value to equity holders. If we want to find values to firm holders, then you include that. Change in working capital, CapEx, like we talked about earlier in that equation, this is just modeling that for every year. And the present value factor includes what we just talked about, and modified CapM, work growth, weighted average cost of capital, like all that I just talked about is in one number, 0.98, 0.93. You're discounting the cash flows over the years. And as a result, you get total enterprise value. More importantly, I want to point out the residual value makes up a huge portion usually of the firm.
What is enterprise value and what is residual? Could you please define?
So you see years, there's like 4 columns, 23 to 27, so that's 4 years. The discrete period is those 4 years. The residual value is what's going to happen into perpetuity. So that's like normalized growth when things are stable. You're going to be growing revenues at GDP rate, or your CapEx is to a nominal amount where it's maintenance costs, or if not, you're expanding, then it'll. But you have to make sure it's a number that's characteristically sustainable into the foregoing future. And that value is bigger because you're capturing all that back end value into the present. So when you add the first 5 years of cash flows discounted to the present, with the present value of all those the last year or future years, you get your enterprise value, how much the entire business is worth today. So we can model this out 10, 20 years and still get $30,000. But instead of modeling it out to 100 years, the terminal value short 10 cents. It's like for like a perpetuity, like dividend, if you get a $1 dividend at an 8% rate forever, you do dividend dollar amount divided by the rate to get the value of that dividend payment. So this is like modeling it in this form. The drivers are discount rates, long-term growth and cap rate. Have you guys learned about that? So how do you get the cap rate?
And divided by a month.
Oh, you're thinking about that cap rate.
Yeah, real
Yes,
estate
that's
cap rate,
technically
yeah,
correct,
yeah,
yes.
yeah.
it is. So in valuations, so a lot of that ties to real estate. A cap rate is driven by exactly that equation. In a financial model, you're actually going to be taking your discount rate, your weighted average cost of capital, minus the long-term growth rate to get to your cap rate. So it's slightly, it's different. Yeah, but that's a good point, you know. When people say cap rate, it depends in what context. Whether, go ahead.
What about the cap M? I wish it, do you use that or no?
Yeah, cap M, like cap M is the same thing as cap M. Like, actually, can you tell me what cap M is?
Capital assets, pricing model.
What's the formula?
It is, I don't know, it's the risk-free rate
Uh-huh.
plus beta times risk, beta is, no, beta times, it's not beta times the risk-free premium.
Equity
Risk
risk.
premium.
Equity risk premium.
Equity risk premium, yeah,
Uh-huh.
minus the
It's already a premium of the.
premium is already done, so you're done, yeah, that's it. Yeah.
Is that right? Is that? Okay, yeah, so this is cap M. And you're like, what about M cap M? We just talked about that. Only difference is you're adding, so it's this equation. Plus you're adding industry risk premium. Plus country specific risk premium. Plus company specific risk premium. It's just a modified version with this formula. Because every company is gonna be, if they operate in 2 different countries, there's risk to supply chain issues or something like that. Or manufacturing costs be different, or there's like currency translations where the dollar is stronger or weaker depending on where it's being manufactured, right? So you want to account for that in industry risk, for example. Or maybe there's like high inflation in that country. So you want to like adjust for that. And then companies, country risk, sorry, that's more country risk. Industry risk is more like depending on the industry that you're in, like technology. Everything's really down in the market right now.
Okay.
But you know, the industry, if it's not, this is more a systemic risk. This beta is unsystemic. Right?
Well, I was gonna say, what kind of beta is that? Whose beta is that?
It's the company's beta.
Oh.
So this actually, interesting, good thing you brought it up. You have to unlever this beta. So when you have comps, like let's say you have AT&T, T-Mobile, Charter, whatever, right? You take all their betas. Let's say this is like 1.2, 1.5, and 2. You have to unlever it. What does that even mean? You know what that means? You have to basically consider their debt and re-lever it with your own debt of the companies. Does that make sense?
You remove the impact of leverage. So anybody in FR 3671 right now, you learn about levered, unlevered beta. Basically, if you estimate the beta of Walmart, for example, as it is right now, that's a levered beta, because that reflects the leverage ratio or the debt ratio of Walmart. So if you remove the impact of that from the beta, you estimate you get the unlevered beta. And it's really simple algebra.
So unlevered beta, you take the levered beta divided by 1 plus 1 minus the tax rate and the weight of debt and the weight of equity. And then once you do that, you get, sorry, that's right. Yeah, you unlever it. And then you get beta that's levered. And then you average Like you take the median of that beta, all these that you like unlever and relever it with the debt that the company's debt. So like, let's say it's like 50% debt to equity ratio. Right, then you would apply this 50% here when you're relevering it. So when you want to relever debt, you have unlevered beta, 1 plus 1 minus the tax, debt over equity. Does that make sense? So you have to like find the betas that you pick the comps in the industry first. Look at the betas, do they look reasonable? If they don't, take it out. They're not part of the comp. Because what this is saying is their risk is similar. They're subject to the same regulatory environmental risk. And then you relever it, and then you take that beta and you put it right here.
I mean,
Yeah.
basically that beta unlevered, those who do not had corporate finance, that's the business beta. Strictly business beta without any infusion, if you will, impact from leverage. So now you have that, and then obviously that is magnified or leveraged through the debt ratio of the company, and obviously consider the debt.
Yeah, and this is called the Pomona formula.
Exactly.
And I learned that from the ASA. You also learned that in finance, but I don't.
365, probably, FR 367 board. Hope 5 minutes.
Market approach. So we have to kind of talk about comps. But if you want to read this.
Yeah.
Go ahead.
I had a question on the DCF chart.
Mhm.
How do you determine future,
That's a good
Yes.
question.
right? And if like, let's say you're gonna get a grant 2026 with $1 billion or something, and you're gonna invest it, how would you know what your company will be worth by 2028? Or
Yeah, I mean, you work with management to uncover what their plans are. Usually you rely on management for everything. Like you don't want to be creating it your own, unless you're like my company and they know what they're doing, because we've been in this business for so long. And we work directly with the government to help them get the grants. But usually management, they'll have a forecasting team. They have an FP&A team. Every company has an FP&A team. And they basically model 10 years out based upon how much money they get and what they're using it for. Based on, and then they do a little estimate of how much demand they'll think they'll generate from that too. And then you have to market that thing like crazy. Like tell them, we're gonna be doing this, sign up, right? There's a lot of work involved. Yeah, so you have like someone who's in charge of revenue, OpEx. There could be teams just focusing on one line item on the P&L, depending on how big the company is. So like they're very similar because of geographic composition. Consolidated communications is around urban areas, so that's location specific. Then the third paragraph is, I guess that's also very location specific too. But obviously, the more demand there is for your service, you're gonna be better off. Like, no one's gonna want to build rural areas. The people who are building rural areas are doing it for the greater good. But most companies are not gonna do that. That's why there's government money to help fund the rural areas. Landline service providers, wireless carriers, satellite, video, voice, over protocol. There's revenue multiples, even the multiples usually relied upon evaluations. But it's, like I said, because everyone kind of touches on a little bit of everything, you want to look at those closely and see what bucket areas that they, in terms of service they offer. Let's skip this. These are comps by category and their respective multiples, and they're all across the board. So that helps you in terms of like narrowing it down, your comp list. Price of revenue, price of the market approach. So I value spectrum licenses. That's using a transactions method. How much did you buy it for? Here's an example of a transaction. 24 gigahertz is bandwidth. And the valuation I just did, they couldn't build it out, given the license they got. So they have to give back. But does that mean there's no value to that license? Not necessarily. Because it could be sold to someone else who might have the capability to do it. So valuation is a very gray area. To you, it might be worth something. To someone else, it might be worth nothing. So it depends on your buyer. And valuation is based off market participant perspective. So anybody who has all the knowledgeable facts, and a willing buyer and willing seller. That's the price that we're trying to pinpoint. There's a cost approach. And I kind of touched upon that earlier, using KPI indexes. It's just an exercise, but when you have an asset listing that's 1,000 pages long, I don't know, something ridiculous, like it adds up. It could be, I worked on one where there were $6 million in 6 assets versus valuing intangible property because they're telecom. I've never done that before, but here I am. And examples of PP&E and coaxial cable, underground fiber, station apparatus. This is what their, or balance sheet looks like.
You remove the values for some reason or.
Yeah, I just didn't put it there.
Okay.
Pretty much it. In terms of
Okay,
timing.
because everything she talked about, you covered it somehow in the class. For that, we've not done valuation, but we will. But definitely some of the, in about 3,000 as well, the corporate finance. And also nothing here, I've had many students, and she probably testifies to that, who find a major in finance and end up in jobs that require a lot of accounting knowledge. This is wonderful.
Heavy accounting. Heavy lift.
So if my advice to you, if you have the time, take an advanced course that you just don't rely on the intro accounting that you took 5 years ago in a community college and you got a D plus.
Yeah, I think this is my first job where I actually had to put together projected income statement, balance sheets, cash flows.
That's valuation. And I want to add one more thing. If you're going to be around for 1 more year, and now that you're aware of the investment research challenge, what did they do over there? What kind of, Gia basically showed you today. I know that the valuation. Relative valuation and discount cash flow valuation is also capital. The risk premium and what have you, and the economic environment, the competition, and legal and whatnot.
Like, weight goes way above your head. But everything that you're learning in class, hopefully you use it in your job, because I did. Like, I literally use everything and more. So, is there any questions? Do you guys have any interest in doing valuation? Or what are you guys interested in doing? Yes, that is a better question.
We have many, again, we've had many graduates who graduate and end up in valuation positions.
It's too hard to get, I think.
Well, but yeah, indeed, but we've had for a few. And because I bring this up because many students don't think about it. It's out there.
I was looking at Anderson, their websites for internships. My brother is a student here, trying to get him to apply for internships. They had a real estate internship. It required like a 3.2 GPA for the valuation one, like 3.5. I don't know how difficult it is to get internships these days, but I highly recommend you do that. I know some of you are probably commuting to school and maybe like trying to work a job or two while doing this. But internships, even though they don't pay, they give you the right experience to talk about it. So I encourage you guys to like reach out to people who you want to become and try to like work with them, whether it's like a call for interning or what have you, I don't know. doing a side project for them. One of the things that I'm gonna be doing, cause I have valuations is a constant, like, a required thing. There's a lot of demand for it. Where there's people reaching out to me about helping them like do consulting work. So I actually have 1.5 jobs right now, because I'm also on the board of a nonprofit organization called the American Society of Appraisers. And I do a lot of marketing and execution of events for them. We're having a speaker from Singapore next Wednesday, if any of you are interested. It's completely free. But
Would you please share the link with us?
yeah, I could share the link. He is a renowned cannabis CPA who does valuations on cannabis. So I'm talking about telecom valuations today, but think about how many industries that this can apply to. And I, as a consultant for over a decade, I've worked on medical, like ambulatory surgery centers. When United Healthcare acquired, before United Healthcare acquired SCA, I did four valuations a month for SCA, surgical care facilities and outpatient care centers.
That's realistic.
I worked on a goodwill impairment analysis for Jacobs Engineering when they acquired CH2 Health. That's $1 billion transaction.
Jacob Engineering is publicly traded.
It's a publicly traded company. So like you get to work on interesting projects. A lot of firms that do valuations are accounting firms, but there's boutique ones too, like Marshall and Stevens in LA is one. Actually, what's his name? The valedictorian or a couple years ago. He's there. Can't remember his name right now either. But the school valedictorian 3 or 4 years ago works in valuations, and I know it's a small world too. So if you know one person, chances are I know them too. So don't burn bridges, small world.
Can I add to that? But the world is small. I got a couple months ago, I got an email from a student, the professor, doing over the job. At the time, I did not put something on LinkedIn. Yesterday, I got an email from another student from like 15 years ago. The professor, we need to hire somebody who's been out to give it. So I thought, okay, I checked with Jacob. Jacob